Think about the last time you spent $20 without a second thought. Maybe it was on lunch, a coffee, or a small impulse purchase. Now ask yourself this, did it matter? Probably not. But what if I told you that the same amount, when invested in a carefully selected portfolio, could generate over $6,000 in monthly dividend income? Sounds too good to be true? Well, in this video, I'll show you how to make it happen. I'll show you and John how to select specific stocks for this target, and in the end, I'll show you how a portfolio of these stocks can turn a $20 a week investment into an over $500,000 portfolio that'll pay you over $6,000 in monthly dividend income. But first, let's take a step back and understand the concept. Dividends are a portion of a company's profits that are paid out to shareholders, usually every quarter. It's how companies share their success with the people who invest in them. When you own shares in a company that pays dividends, you get a cash payment based on the number of shares you hold. For example, if a company declares a $1 dividend per share and you own 100 shares, you'll receive $100 in dividends. The best part, you don't need to sell your stock to make money. This income is just for holding on to those shares. Dividends can play a huge role in building passive income. Let's say you invest $1,000 into a company that offers a 5% dividend yield. Over the year, you'll earn $50 in dividends. And remember, this doesn't involve selling your investment. It's money paid to you just for owning the stock. Over time, as companies increase their dividends or as you reinvest your dividends, that income can grow even more. But not all dividends are the same. Some companies have a history of consistently raising their dividends, making them great for long-term growth. On the other hand, some might cut or suspend their dividends when times get tough. So it's crucial to focus on companies that have a strong, steady track record of paying and growing their dividends. Now, when it comes to receiving dividends, there are two main strategies: dividend reinvestment plans, or DRIP, and non-DRIP investments. To reach a $6,000 per month income with only a $20 a week contribution, you need to know how this works. First, let's look at non-DRIP investments. With non-DRIP, the dividends you earn are paid out to you in cash and you have the freedom to do whatever you want with that money. For example, let's say you make a one-time investment of $1,000 in a stock with a 5% dividend yield. This means you'll earn $50 in dividends at the end of the first year, 5% of $1,000. Since you're not reinvesting the dividends, you simply receive that $50 in cash. Over the next 2 years, you continue to receive $50 in dividends annually. However, your initial $1,000 investment doesn't grow unless you add more money or invest elsewhere. You're essentially receiving a fixed return on your original investment without seeing any compounding effect. Now let's look at DRIP, dividend reinvestment plans, which is a much more powerful way to grow your investment. With DRIP, the dividends you earn are automatically reinvested to purchase more shares of the same company. So, using the same $1,000 investment in a stock with a 5% dividend yield, you'll earn $50 in dividends at the end of the first year, just like in the non-DRIP example. However, instead of receiving the $50 in cash, that money is used to purchase more shares. If the stock price is still $100 per share, you would use the $50 to buy half a share. At the end of year 1, you now own 10.5 shares instead of just 10. This extra half share will start earning dividends as well. In year 2, you'll earn dividends based on the 10.5 shares you now own. Instead of receiving $50, you'll receive $52.50. That's 5% of $1,050. This $52.50 is automatically reinvested to purchase more shares. At the end of year 2, you now own 11.025 shares. In year 3, you'll earn $55.13 in dividends, which is 5% of $1,102.50, which will again be reinvested to buy more shares. By the end of year 3, you now own 11.576 shares compared to the 10 shares you started with. The key difference between non-DRIP and DRIP comes down to the compounding effect. With non-DRIP, you're receiving cash dividends each year, but your total investment doesn't grow beyond the initial $1,000 unless you make additional investments. Over 3 years, your $1,000 will have earned you a total of $150 in dividends, bringing your total value to $1,150. However, with DRIP, your shares are continually growing due to the reinvestment of your dividends. By the end of year 3, your $1,000 investment will grow to 11.576 shares worth $1,157.60, assuming the stock price stays at $100. While the difference might seem small after just 3 years, the power of compounding becomes more noticeable over a long period. As the years go by, your dividends will grow faster, and the compounding effect will work to your advantage, accelerating the growth of your investment. This makes DRIP a powerful strategy for building wealth over time, especially when you're aiming for consistent passive income. Now that you've got the basics down and understand the difference between DRIP and non-DRIP strategies, let's look into how to pick the right stocks that'll help you reach your income goals. When selecting stocks for generating passive income through dividends, there are a few key factors to consider for long-term success. First is dividend yield, which indicates how much income a stock generates in dividends relative to its price. While a higher yield often means more income, it's crucial to make sure that the dividend is sustainable. Companies with a strong history of paying and growing dividends are ideal because they're more likely to continue providing reliable payouts. Company stability is another important factor. Stocks from companies with a solid financial history and consistent profitability are generally more likely to maintain or even grow their dividends, even during periods of market volatility. Industries like consumer staples and utilities are often more resilient since they provide essential products and services that remain in demand regardless of the economic environment. Then there's diversification. Relying too heavily on one stock or sector can be risky, so spreading investments across various industries reduces the impact of a downturn in any one sector. For example, holding stocks in both real estate and technology helps protect against sector-specific risks. Lastly, it's essential to consider a stock's growth potential. While dividends offer immediate income, stocks with strong growth potential also provide long-term value. Companies like Lowe's and Schwab not only pay reliable dividends, but also show solid growth in share prices, offering both income and capital appreciation. Based on these criteria, the following 5 stocks have been carefully chosen for their ability to generate reliable income as well as their potential for long-term growth. First on the list is CubeSmart, with the ticker symbol CUBE, or Cube. Cube is a real estate investment trust, or REIT, that specializes in self-storage facilities. The company's business model relies on collecting rent from its storage units, which provides a steady cash flow. Self-storage has proven to be a resilient industry, even during economic downturns, as people often need extra storage space regardless of the economy. Its consistent income allows it to pay reliable dividends, making it an attractive option for income investors. CubeSmart has a dividend yield of 4.89%, which is higher than the average dividend yield of the broader market. Over the past 10 years, CubeSmart has maintained an impressive dividend growth rate of 14.06% annually. This growth, combined with its stable cash flow, makes it a strong choice for those looking to generate passive income over time. Additionally, CubeSmart's annual share price appreciation of 5.87% further adds value to its investors, making it a balanced choice for both dividend income and long-term capital growth. Next, we have Schwab US Dividend Equity ETF with the ticker symbol SCHD. This is an exchange-traded fund that invests in a diversified portfolio of U.S. companies with a track record of paying high dividends. This ETF allows investors to gain exposure to high-quality dividend-paying stocks across various sectors, such as consumer goods, healthcare, and energy. By investing in SCHD, you're automatically diversifying your portfolio, reducing the risk of relying on any single stock. SCHD offers a dividend yield of 3.53%, which may seem lower compared to some individual stocks, but the ETF's appeal lies in its diversification and stability. The ETF's dividend growth rate of 11.04% over the past decade shows that it's steadily increasing the income it provides to its investors. Furthermore, SCHD has an annual share price appreciation of 6.23%, ensuring your investment grows over time, not just through dividends, but also through capital gains. Now remember, later on, in the end, I will show you how SCHD and Cube, with the rest of the stocks in this portfolio, can turn a $20 a week investment into over a $500,000 portfolio that will pay you over $6,000 in monthly dividend income. Next, we have a retail giant that offers strong dividend potential, Kroger, with the ticker symbol KR. Kroger is one of the largest grocery retailers in the U.S., operating under well-known brands like Ralph's, Fred Meyer, and Harris Teeter. The grocery business is essential and relatively stable, making it an excellent choice for those looking for consistent dividend payments. During both economic booms and downturns, people continue to buy groceries, making Kroger a reliable source of income for shareholders. Kroger's dividend yield of 2% might be modest, but it has one of the best dividend growth rates in the industry, with an impressive compound annual growth rate of 13.58%. This means that even though its yield is relatively low, the company consistently increases its dividend payments, which makes it an attractive choice for long-term investors looking for dividend growth. Kroger's annual share price appreciation of 4.8% further boosts its appeal, providing a balance of income and capital growth. Next on our portfolio, we have Lowe's Companies with the ticker symbol LOW, or Low. Lowe's is a leading home improvement retailer and competitor to Home Depot in the U.S. The company provides products and services for DIY projects, home renovation, and the construction industry. Lowe's has benefited from the growth in the housing and home improvement market, especially during times when people focus more on home improvement projects rather than buying new homes. This steady demand provides Lowe's with consistent cash flow, making it a solid choice for income-focused investors. The stock offers a dividend yield of 1.87%, which is on the lower side compared to some other dividend stocks, but its dividend growth is exceptional. Over the past decade, Lowe's has achieved a dividend growth rate of 17.99% annually, one of the highest in the retail sector. This makes Lowe's a great pick for investors who are more focused on future dividend growth than immediate yield. In addition to the impressive dividend growth, Lowe's annual share price appreciation of 12.72% adds another layer of potential return for long-term investors. Finally, there's the tech stock NetEase with the ticker symbol NTES. It's a leading Chinese technology company that specializes in online gaming, e-commerce, and advertising. It's one of the largest online game developers in China and is well positioned in the fast-growing gaming industry. The global gaming market has been expanding rapidly, and NetEase stands out as a key player in this space. The company has also diversified its revenue streams, which helps to reduce risk and provide more stability for investors. NetEase offers a dividend yield of 2.57%, which is reasonable considering its growth prospects. The company's dividend growth rate of 17.29% annually over the past decade reflects its commitment to rewarding shareholders. Additionally, NetEase has shown an annual share price appreciation of 17.78%, driven by the company's strong performance in the gaming sector. This high growth rate makes NetEase an appealing option for investors looking for both capital gains and dividends. So now that we have 5 stocks selected, the next step is to calculate the portfolio dividend yield, dividend growth, and price appreciation. For this portfolio, the dividend yields of the 5 selected stocks are as follows: CubeSmart at 4.89%, SCHD at 3.53%, Kroger at 2%, Lowe's at 1.87%, and NetEase at 2.57%. To calculate the average dividend yield, simply add up these yields and divide by the number of stocks in the portfolio. So 4.89% plus 3.53% plus 2% plus 1.87% plus 2.57% divided by 5 equals 14.86% divided by 5, which gives an average dividend yield of 2.97% for the portfolio. This tells you that, on average, your investments will generate 2.97% in dividends annually based on their current share prices. You can apply the same method of averaging to calculate the dividend growth and share price appreciation for the portfolio. So, if you combine these stocks, you'll have a portfolio with a current dividend yield of 2.97% and a strong average dividend growth rate of 14.79%. It'll also have an average share price appreciation of 9.48%. So what does this actually mean for your money? Well, let's say you stay consistent and invest $20 a week in this portfolio over time. After 1 year, you would have saved up $1,040. This sets the stage for future investment and growth. After 5 years, your weekly contribution, along with capital appreciation and dividend reinvestments, will be valued at $6,732. In 10 years, your portfolio would grow to $19,697. Give it 10 more years, and your investment, after 20 years, will be valued at $108,242. This is when the compounding effect really starts to take full effect. And after 30 years, your portfolio would be valued at $706,842. At the same time, you would be receiving $76,621 per year in dividends, or around $6,385 per month, just from your $20 per week investment. The total value added to your portfolio would be $675,642, with $317,736 from capital appreciation and $357,906 from dividend reinvestment. Want more in dividends? Click the video on the screen to find out how to earn over $20,000 in monthly dividend income with the same investment amount.